Hi, it's Roger Gershman at the Gershman Group. Why are so many advisors going independent from big banks and brokerage firms? I'm astounded by how many are not only interested in moving and starting their own firm, to those who are actually moving at record pace. For my business, it's approximately 50% of advisors are interested in independence and actually moving there. Why? Because now you have platforms that do everything for you. Choose your custodian, Fidelity, Schwab, Pershing, Goldman Sachs. Help you with everything, back office administration, technology, legal, HR, investment solutions, trust services, family office services, lending services. But it's your name on the door, and it's turnkey. The net operating margins are, on average, 60 to 70%. Pre-tax, your tax, 1099 income. The valuations are approximately 7x your net operating income, meaning that there's tons of private equity dying to invest in you day one. You are the house. You own your clients. You don't work for anybody but yourself. You want to acquire other businesses, you want to retire and sell it to your family or your colleagues, go ahead. You are in complete control. Compliance is a fraction because you're addressing your highest common denominator, yourself and your business. There's very few firms that have done it really well. Here today is an interview with Vince Fertitta, who is the president of Sanctuary Wealth, the fastest growing independent platform in the United States, who has brought on countless Merrill Lynch teams. Why? Because they came from the firm. They understand the trials and tribulations and the issues, concerns of the platform, but also how to move them to independence. But that's just Merrill. It's similar at other firms as well. And the firm is booming. And here is an interview with the president to tell you why and the value proposition that Sanctuary Wealth holds. I'd like to introduce you to Vince Fertitta of Sanctuary Wealth. Vince, excellent to see you again. Greatly appreciate the opportunity to take a few minutes of your time.
My pleasure. Always great to see you, Roger. Looking forward to it.
Done deal. Well, look, Vince, it is absolutely incredible from my perspective about what's going on in the independent world. I mean, there seems to be a perfect storm, right? Advisors at Merrill and Morgan and UBS and are really complaining about the weight of these firms and compliance and how they do business. But then we're also seeing an explosion of advisors taking that model, going independent, and the ease to go independent. So from your perspective, what is happening?
I mean, look, I think that the industry, the independent industry really, but the wealth management industry as a whole evolved. It's that simple. It evolved to meet a demand that was always there, right? Like I got in this business in 1992, but I grew up in it because my dad was an E.F. Hutton stockbroker going back to the 60s. It's always been an entrepreneur's business, right? You don't reach the levels of, you don't become $1 million producer or a $5 million producer unless you're an entrepreneur. And entrepreneurs are never going to be happy in an employee model, even if they work for a great employer. And so the industry's evolved, right? It goes all the way back to, when Wachovia created FiNet, it kind of created this supported independent model, and then it just keeps getting better and better. The technology keeps getting better. And so now it's a viable option for these entrepreneurs to own the business that they've always wanted to own. And then they see one of their friends do it and they realize that it's not so dangerous and you can actually accomplish it. And so the movement just kind of, the snowball effect.
Kind of interesting. You mentioned your dad was an advisor. So was mine. My dad worked for Merrill Lynch for 25 years.
Oh,
wow. And so tell us a little bit with that. What is your background and what motivated you to, take the leap of call it faith?
Yeah, I mean, I was a financial advisor. I started right out of college with what is now Morgan Stanley. It was some version of Smith Barney. In fact, I think it was called Shearson Lehman Hutton when I started. but I had 5 business cards in 4.5 years because it was going through all these name changes. Yeah. And then I was recruited to Merrill, as an advisor. So I stayed a financial advisor for a total of 10 years. And then I had an 18-year leadership career at Merrill Lynch. And at the end of that career, I was divisional executive. So there were 6 of us around the country, really kind of running the country as an executive committee. So we did have field responsibility, but it was, I had 2,200 advisors. It wasn't like I could really impact the advisors. I was impacting the company. And then, as you know, Merrill Lynch is owned by Bank of America. And so of the 6 divisional executives, the CEO of Bank of America had asked 2 of us to play a role within the bank as well. And so I was a market president for Bank of America, as well as being a divisional executive for Merrill. In the market president role, you're more of a direct report to the CEO. In my divisional executive role, I reported to the head of Merrill Lynch, and then he reported to the CEO of Bank of America.
And so you saw clearly the model changing and the interest of the advisors changing. And, advisors ask us all the time, what's happening with Merrill? Like, what's going on, right? And it is happening at other firms, but it seems to be particular Merrill. What, from your perspective, what's happening?
Yeah, it is happening everywhere, by the way. I think Merrill advisors have an obvious scapegoat, to talk about it being Bank of America, some of it is the bank's culture. It is a big bank, right? But there are other big banks out there too. I think it's more about corporate America than it is our industry. It's just, we live in a very regulated industry. We live in a very highly regulated country where, HR and legal and compliance are running these companies much more than they did before. And I don't think that they're necessarily wrong to do that. I think they're pushed that direction, but it's not, it makes it much less entrepreneurial, to work for a company like that, where everyone has to be treated like the lowest common denominator. And I don't think that is limited only to our business. I don't think it's limited only to the big banks and brokerage firms. We at Sanctuary, we treat our people to the lowest common denominator too, but we manage the lowest common denominator. What I like to say is we can look a regulator in the eye and say, yeah, we treat all of our people like adults because we only have adults. They all have third-party accreditations, tenure in the business. They have clean U4s. They're advisory focused. They're centered around financial planning. If that's all you have, then you can treat them a certain way. But if you have 15,000 advisors and someone's doing something really wrong right now, those companies have to treat you like it might be you that's doing something wrong.
Yep, totally get it. So clearly, supported independence is a burgeoning, booming business, and Sanctuary really sits at the top of the heap. So why do you think that is? What is the Sanctuary advantage?
Honestly, I think our biggest advantage is our culture. Yes, we speak the language, right? With myself and so many others at Sanctuary, having a deep wirehouse background, having been financial advisors ourselves, we speak their language probably better than most. But we've also been super protective of the culture, right? Like when we were building Sanctuary, we were very deliberate. We had a concern, right? Like when I'm a big believer that all of us are product of the people we've been around our whole careers, right? So if you think about that and you go, well, these financial advisors, at some point in their career, they were inspired by someone and they started moving a certain direction because of that. And then over time, they picked up an idea from this person and an idea from that person, and they went to this meeting and they heard this speaker. And over time, they evolved into who they are, which is really a product of all of these experiences. So we were concerned when we were building Sanctuary and we were thinking about bringing these successful advisors independent, that if we didn't provide that type of environment, they might plateau, right? Their business might become stagnant. Because the best advisors I knew and led at Merrill, even the biggest ones, a $15 million producer, whatever it may be, they're always looking for an idea from someone else. So we created this culture. We have 76 partner firms. They all own their own business completely, right? They've hired Sanctuary, but we don't own any part of them. We don't show up on their business card. They have their own name, brand, logo, but we've connected them. So they feel like they're part of this same elite network, and they root for each other. They collaborate with each other. They compete against each other in a very friendly and productive and healthy way, and they benefit from each other. And at the end of the day, they're better because of the culture, and their clients are better served because of the culture. And so kind of what is our secret? It's that if you're an advisor at Morgan or Merrill or whatever, I can connect you with someone who was just like you 2 years ago. They do the same level of business at whichever firm, and they've moved and they're independent with Sanctuary. They sell them. I don't sell them. I just connect them with one of our partner firms who tells them how great it is.
Got it. So including culture, it is also your expertise in supporting the advisor. It's compliance, it's operations, it's systems, it's technology, it's the platform. And so you seem to execute, right? It's execution, right? You are the service provider for these advisors. So that certainly is a competitive advantage.
Yeah, of course. And a lot of the services that we provide, we didn't provide 2 years ago, right? So I think the other thing that's unique about Sanctuary is that we truly listen to the advisor, right? It seems simple and it seems obvious, but most people don't do it, right? Like I was a financial advisor. I've been in the business for 30 years. I know what they need. And so you would you'd be tempted to just go build what you think they need. We don't do that. You know, we talk to advisors. I talk to multiple advisors every day, whether it's our current ones or it's people at a wirehouse somewhere. They tell me what they need. What do you need to be successful in this business? What do you have today at, Merrill that you're going to need when you go independent? And then we go build it. We have a phenomenal team at Sanctuary. We have all these people from, wirehouses who speak the language, and you hear about us and you see us. But we have this incredible group of people who spent their whole career on the independent side. And I mean, these are people who could build a space shuttle, right? I mean, they are really good. And we just tell them this is what the advisors need, and they go create it and we execute it. And we have this mindset that's more than a mindset. We embrace the fact that we're vulnerable, right? So a really good financial advisor team knows that their clients can fire them, right? And so everyone on that team bends over backwards because they're vulnerable to their client. We're vulnerable to our clients, right? Our partner firms can fire Sanctuary anytime. If we're not adding value to them, we have to expect them to fire us. And so everyone at Sanctuary bends over backwards to make sure that we're providing that level of service and executing. And if we get it wrong, and we do get it wrong, then we own it, we apologize for it, and we do whatever we need to do to make it right.
Right. So compensation is a key point for any advisor considering a transition, right? They know what they're going to get if they go from Morgan Stanley to UBS and Merrill to, Morgan, right? And they know how they're taxed as well. Can you explain the economics of independence, right? What the rough expected net income is, the tax advantages, and the valuations of these businesses day one? So they have a really good understanding of the competitive market and the traditional space, but may not have as good as a feel on the independent side.
Yeah. You know what? I've looked at all kind of different models of independence, whether you do it completely on your own and you hire your own compliance officer, an IT person, all that, or you hire someone like Sanctuary or some other supported independent provider. And at the end of the day, the net numbers all come in a very, very tight range. It's usually between 60 to 70% margins. That's what you can expect. If you're a bigger business, if you do 10 million, you'll be closer to 70. If you do 1 million, you'll be closer to 60. Of course, geography matters because you're paying rent on real estate, and salaries can be higher in certain markets for your support staff. So those are variables, but you'll be in that 60 to 70% range. You'll be taxed as a business owner. It's not W-2 income, it's 1099 income. So you work with your CPA, and you all have business owner clients. You see that they probably have some tax advantages over you as a W-2 advisor, and you're in that situation once you're independent. So I tell people, and maybe I sell ourselves a little short at Sanctuary when I do this, but Like, you're not going to find that we're the high cost provider or the low cost provider. We're all coming in about the same if you do an accurate side-by-side comparison of pro formas. So I always advise people, anyone you're considering, get a pro forma, provide them with the same assumptions you're providing us, and you'll probably be within a point or two, one way or the other.
And then their valuation day one, right? They know what their valuation is roughly going from Morgan to UBS. But what's the valuation day one typically, right, of a independent firm?
Yeah, well, day one, it's zero. They don't have any clients, right? But, day 366, right, when they've been here 12 months in a day and they've moved, our people, the average is they move 90% of their assets and they're over 100% of their revenue. So now their complete business is moved from whichever wirehouse to the independent world, and they're no longer subject to short-term capital gains because it's been a year, and it's long-term capital gains. You can find multiples are based off of EBITDA, and they're based off of EBOC, earnings before owner's compensation, which can get a little complicated for someone to think about when they're in the wirehouse. So if you back into the numbers they're used to and you say you're worth 3 times your trailing 12, if you move from, Merrill to Morgan, you're worth probably 5 times in the independent world, right? The bigger you are, the bigger the multiple. Now, it's not an apples to apples, because you don't value a company that you're going to buy as a multiple of revenue. You value it as a multiple of EBITDA. But, if you wanted a thumbnail kind of back of the napkin, I would say if you can get 3x today from a wirehouse competitor, you can probably sell your business for 5x or more on the independent side, and it'll be capital gains treatment.
Got it. And so Sanctuary is interested in taking equity stakes in these businesses, right? As early as possible, because from your vantage, day 365 is probably one of their least expensive valuations, because they're only going to grow from there, right? Tell us about your interest in taking equity stakes in these partner firms, and what's the advantage to have Sanctuary as an equity partner?
Yeah, we don't push people to sell as part of it. That is something some of our competitors require it, or they really kind of make you feel uncomfortable if you don't do it. We made it available for where we will take an equity stake in a company. The main reason we did that is because a big part of our business plan is this realization that $1.5–2 trillion of client assets are going to change advisors in the coming years, based solely on demographics, right? And that when you're in the wirehouse, they all have these retire in place programs, which are not very good, honestly. But in the independent world, people just sell that business. Mm-hmm. So what we wanted to do would be provide an opportunity where our partner firms that we've broken out of the wirehouse and now they own their own business, where they could go buy one of these existing independent firms. And the way we do that is we say, listen, if you're serious about that, and this firm that you're interested in buying is going to cost you $20 million because it does $4 million of revenue or whatever it may be, here's what we'd like to do. We'd like to first make an investment in your company, a minority investment, where we'll buy, say, 20% of your company. And so if you do $4 million, it's probably worth $20 million too. So we'll buy 20% of your company. Then we'll go buy this other company. We'll write the whole check. Not only will we write the check, but we'll manage the due diligence process. We'll bring in the legal team, the integration folks. We'll help you figure out if that's the right price. We'll write the whole $20 million check to buy them out. And then you pay us back for the portion you would like to own. Now, we at Sanctuary, we want to own 20 to 40%. We don't ever want to be in control. That's your business. You're in control, right? We want to be a passive minority investor. We have some controls, so we're not taken advantage of. But you're going to pay us back. If you say we want to own 80% of the combined entity, then you're going to pay us back 80% or $16 million in that example. You're going to pay us back over the course of 4, 5, 6 years out of cash flow from that business. And then you're going to own this asset. You own 80% of the asset. We own 20%, and we're just an investor at that point.
Terrific. It's very entrepreneurial. Can you talk about process, right? Day one, from an introduction to Z, right? When you join, what can an advisor, expect in that process? How it maybe differs from the traditional wirehouse side, if it does much, and what can advisors expect that first day at their new right? New firm.
Okay.
And how different is that experience?
So taking someone through the process, right? When you introduce me to someone, either myself or one of the regional directors at Sanctuary is going to have an introductory conversation with them. Usually it's about an hour, and that's to get to know each other, right? We'll tell you a little bit about Sanctuary. You tell us a little bit about your business. And if there is a mutual agreement that we should dig a little deeper, then we do. Now, when you introduce someone, you've already taken the time to know them backwards and forward. You already know Sanctuary backwards and forward. So almost 100% of the time, we're going to go to the second step, which is a deeper dive. The deeper dive is about a 2-hour-long presentation, less of a conversation, more of a presentation of our offering. And it culminates in us going into detail about how we do a transition and the economics. Here's what your P&L would look like if you were currently independent. That is really valuable. So that process continues, and there's usually some back and forth on trying to understand the P&L. We do technology demonstrations. And like I said earlier, we put them in front of our other partner firms. Ask them what they think about it. Don't ask Vince, right? Ask them. And then at some point, they agree and we agree that we want to work together. We extend a formal invitation to them in the form of a letter of intent, where we agree that we'd like for you to join us. You've agreed that you would like to start your own business and hire Sanctuary, and we'll do it on X date. We're going to do it on June 15th. At that point, our transition process really ramps up. We have a very methodical and thorough transition process that's led by executives from the wirehouses who know how to move a book from Merrill or Morgan better than anyone, and UBS and Wells and all of them. They took you through what is designed to be a 12-week process that starts with real estate, marketing, websites, custodial selection. We're multi-custodian, so we can support all of them. We need to help you figure out which one. And then it talks about creating your list, whether it's protocol list or non-protocol list, and what you can bring with you and what you can't, and how you need to react. Do you shoot a video when you leave? Do you not shoot a video? How do we distribute that, right? So that is a very methodical process. It's designed to be 12 weeks. If someone gives us more time, that gives us more time for things like real estate and marketing. When they give us less time, I always say, hey, it's the same number of hours that you need to study for the final exam. You're just wanting to do it in 6 weeks instead of 12 weeks. And so if you're game, we're game, but it may not be so pleasant, right? And then what happens is when they resign from their company, they are walking into a fully functioning business that we built for them to their specifications while they were still an employee there. And so we've already secured the real estate. The website goes live. Our transition team is there. The people they've been talking to every week are waiting for them. The custodians team is there. And all they have to do is start calling clients and getting yeses. We're filling out the paperwork. While we're filling it out, after the first probably couple of weeks, we start to train their team on how their team can start to fill them out at some point. But we don't expect their team to know these forms, day one. So we're really doing all of that, kind of administrative type work while we're teaching them how to do it.
Really neat. So it's almost like equivalent to being an employee at, say, Morgan Stanley, where the systems and operations technology is all there for you and you're just managing money. You have your research, you have your structured products, you have your offerings, and you're just really managing money just like advisors have done all the time. But this time it's their firm and it's Sanctuary offering the back office administration services. So they turn on the lights and they're operating just like they would at their current company.
That's exactly right. They just don't have all the distractions that their current company is putting in front of them, So and they have more opportunity for top line growth. And that's something that, I should probably talk more about, because we talked about the margins, right? You're making, say, 45% at whichever wirehouse. Now it's going to be 65%. But you're also going to make that on a higher top line number, because when you're independent with a firm like Sanctuary, at least, there's all this opportunity swirling around you while you're at the wirehouse that you can't touch, right? Client wants advice on their 401k. Ooh, I can't do that, right? Client's investing in some direct investment and they would like my input on that. I can't do that, right? Clients selling a business, or they're selling a building, and there's going to be a 1031 exchange. I can't do that at the wirehouse, right? So there's all kind of things like that. Client wants me to advise them on their overall financial picture, even though some of their money is with me and some of it's at this bank and some of it's there. You can't do that at a wirehouse. You can only advise on what's with you. When you're independent, if you and the client agree that you're going to advise them on all of these things that I just talked about, you can bill for that advice. And most clients are more than happy to pay for that. Maybe it's just a hard dollar financial planning fee, whatever it may be. So their top line is going to be much higher than it is at their current firm, and they're going to have a higher margins, and they've unlocked this asset that they can sell at a value that's much, much higher than they could ever do while they were at the wirehouse.
It's neat. A lot of advisors think that, because they work for Merrill Morgan, it's the name of the firm, and they're a little apprehensive, right, at going independent. And so, I tell them, and I trust you do the same. I mean, the Schwabs and Fidelities and Pershings and all the platforms that use, including now Goldman Sachs, as I understand, clients are just used to custodian, and they're used to their advisor, and they understand that these big name firms, like, they're big banks and they're nickel and diming their clients, and it's and dealing with bigger issues. And so the success of independence from traditional banks or brokerage firm are widely more successful than these advisors believe it will be, having their own name on the door. Can you explain that experience?
Yeah, and I'm glad you asked that question, because that is something that's in the back of a lot of advisors' minds. I talked to a team yesterday that was thinking along those lines, and you're absolutely right. Like, what the client cares about is, where are my assets, right? I'm comfortable when they're at Morgan Stanley or UBS or Merrill, because I know those places are going to look after them. Well, they're not going to be with, their assets are not with Sanctuary, and they're not with, Rogers Private Wealth. They're at Charles Schwab, right? They're at Bank of New York Mellon with 35 trillion other dollars, right? They're with Fidelity. Well, the clients gain instant comfort with that. It doesn't take much, right? These companies have big brands, they're advertising, and it doesn't take long to explain that to a client. In many cases, the clients are actually much more comfortable with the situation. I don't have to do it very often, because we have phenomenal advisors who have launched their business with us, and they can tell the story. But every now and then I'll be asked to describe to a client what this new structure is. And the way I'll do that is I'll say, okay, you're currently at Merrill Lynch, right? And so your advisor is Merrill Lynch. And I know you think it's Roger, because Roger's an employee of Merrill Lynch, and it is Roger, but Roger's an employee of Merrill Lynch. And so essentially Merrill Lynch is the advisor. Where are your assets held for safekeeping? Merrill Lynch. So Merrill Lynch is your advisor, and they're your custodian. Mm-hmm. And then who's overseeing that relationship to make sure that your best interests are taken care of, and that you are, that the advisor is fulfilling their obligations to the regulators and all that? Well, the one doing that is also Merrill Lynch. So all your eggs are in one basket from that standpoint. Now that you're in, and that's perfectly safe, because it's a big, stable company. You have nothing to worry about as long as that's your structure. In this new structure, Roger is your advisor. There's no employer over there, maybe trying to manipulate Roger to do things that he may or may not want to do for you. There's no influence like that. Roger's your advisor. It's a bespoke relationship between you and Roger. Your custodian for safekeeping of the assets is Schwab or Fidelity or Pershing or whoever it is. And you talk about how safe they are. And then Sanctuary is just a firm that was created to, behind the scenes, oversee that relationship from a supervisory and compliance standpoint to make sure your best interests are addressed and that advisor is fulfilling their obligations to the regulators.
So I often hear that advisors, clients, really embrace it, right? They like the fact that it's their company and the referrals are larger than expected. And that's just not me selling it or you selling it. It's the truth. So tell me about the success of these advisors, at Sanctuary in their first year or so, on the client reaction, assets transferred. How are they doing?
Yeah, so the numbers are about 90%, right? Whatever your assets were when you left, you had $1 billion when you left. 12 months later, you have 900 million, right? And those numbers, we've seen them much higher than that, but it's 900 to 960 million, or 90 to 96% is what we consistently see. Now, it's a little misleading, right? Because for many years, the markets were helping, right? The market was moving the asset level higher. The other thing is, yeah, you will leave some clients behind. It's probably not the clients that you really are wanting to bring with you, but you will bring some behind, but you will replace those with referrals like you've never seen. And that's what you were alluding to. And it's amazing. And it's because, in my mind, it's because your clients that stay with you, they know that you just did something pretty bold and they're proud of you and they are rooting for you. It's different. Like if you went from Merrill to Morgan, they'll tolerate that disruption, but they know that wasn't very bold. You probably got paid a ton of money to do it and they'll tolerate it, right? When you do this, they applaud it and it's very different. And then they want to know, how can I help you? I'm so proud of you. This is so exciting. How can I help you? And so they're advocating for you in a totally different way than you've ever experienced before.
That's an incredible story. It's really neat to hear that. So finally, tell me about the success of Sanctuary. Certainly the firm is exploding, right? It's been an incredible year. And what is your expectations for the firm, not only this next year, but the years going forward? Where do you see yourself and the firm in 5 years from today? Where do you see the industry in 5 years? What's your future look like?
Yeah. Well, thank you. We've certainly been blessed. We feel great about it. Like I said, success breeds success. So when we bring a very well-respected, breakaway team, and we help them go independent, we'll get 3 more that look just like them, right? And so it just kind of snowballs. But I think we've reached, sort of the level of capacity and transitioning new teams that we want. We've sort of settled in after the last few years. And so, I think this year we'll continue to invite we should probably onboard 20 new teams and around 60 million of trailing 12. That's what we did last year. It's what we did the year before, roughly. And we're very comfortable with that. It's one of those things that you can overdo it, right? Like if I was a financial advisor and I was bringing on so many accounts that I wasn't able to service the ones that I had, I would need to manage that. And so we've managed it. We're very comfortable at that level. The good news is that we tend to sign letters of intent, 3 to 6 months before the people actually launch their business. So if for some reason this year we have an onslaught of great new opportunities and we decide to take them, and we don't do 60 million, we do 100 million, we'll have plenty of opportunity to hire and train ahead of that. So it's kind of a nice lag that we have in our business development. But our future is, we have 76 partner firms. It's about 25 billion of assets under advisement. It's 28 states. We're going to continue to grow, like I said, at about 20 per year. At some point, we'll reach critical mass. That's probably around 150 partner firms. It doesn't mean that we're going to stop growing at that point, but we might change our focus to some degree. Because remember, the part of our business plan that I described earlier, where we want to help our partner firms go buy others. Well, once we have, call it 150 partner firms, and we have the major markets covered with, 3 or 4 partner firms, and Los Angeles and, 5 in New York or whatever it may be, then we're better positioned to start focusing more on helping them grow inorganically by partnering with them on these acquisitions.
Right.
And so we'll continue to grow, but we'll grow through our partner firms and less so from breaking away more and more and more.
Terrific, Vince. Well, look, with that said, really appreciate the opportunity to speak. Enlightening. Congratulations on a huge success, and as well as the next years going forward.
Thank you. It's my pleasure. Look forward to the next time.